Hey everyone, if we're meeting for the first time, my name is Vojchehoske and welcome to the Real Estate Classroom YouTube channel where my mission is simple, and that's to help you pass your real estate exam the first time. All right, so let's continue on with our really important real estate vocabulary words. Today, all of our words we're going to discuss evolve around evaluations, appraisals, and all the concepts that evolve around that. So 259 of 300 is the first one. It's sales comparison approach. Now you have to know this for your exam, that sometimes the sales comparison approach is called market data approach. They're the same type of appraisal, but they're just sometimes called two different things. All right. So this is where this is the, the typical appraisal that we see for single family housing. And a lot of the processes to determining value is what we as real estate agents also use in our what we call comparable market analysis, which is referred to as a CMA. This is where we take the subject property, the property that we are trying to determine the value on, and we determine the value by comparing it to similar properties within the same area that have recently sold. And there is a formula or a methodology of doing that. I'm not going to go into that in this video, but one thing I do want you to know that with all of these different types of appraisals we're going to talk about in this video and the other concepts such as GRM and all of that, I'm going to put links to videos I've already done for these concepts in great detail down below in the video description. And if you look here on your screen, we are looking at the methods of determining that value as well. Step 1 through 5 there. Number 260 is cost approach. Now, cost approach is the second type of appraisal that we're going to talk about here. And it's a type of appraisal that estimates the value of property that's not common. So remember, in the sales comparison approach, that's where we determine value of single-family homes based on comparables, other single-family homes that have sold in the area recently. With this type of an appraisal, there are going to be no comparables because the property is unique, such as a church or a factory or a library. And the formula that the appraiser is going to use is we take the land value plus the construction cost, add those two numbers together, then we minus out the depreciation of the current building. And that equals our appraised value. Again, I've done a video on this that goes into great detail, and that is down below in the video description. Now, the third and final type of appraisal I want to talk about is income approach. One thing I want you to remember, that income approach type of appraisals are only used for income producing properties, period. And most of the time, they are not used, almost never are they used for single family homes, even if that property is being used as a rental property. All right, we're talking about apartment communities, strip malls, those type of things. Income approach is used for income producing properties. I'm going to kill that dead horse here. So there is a formula that is used, and it's called the capitalization rate that the appraiser is going to apply. It is the net annual operating income, net income. That's gross income minus expenses equals your net operating income, but it's the annual NOI divided by the capitalization rate. When you multiply those two numbers, we get a cap value. Again, look down below for the video where I describe this in great detail. 262 is depreciation. Now, depreciation comes basically in two different forms. The first one is actual loss in value. It's a real loss in value. And then there is what we call a book or paper loss for income tax purposes. All right. So there are three forms of depreciation that fall under this category. It's physical depreciation, functional obsolescence, and economic obsolescence. So number 263, one of those types of depreciation that we just talked about is functional depreciation, or sometimes known as functional obsolescence. Now, functional obsolescence can come into two forms, curable and incurable. So the term obsolescence simply means that Something is out of date. Your property that you own is out of date, or you didn't keep it up to date. You're not, the kitchen's out of date, the bathroom's out of date. The style or the floor plan is no longer in line with market requirements, meaning the buyers don't want it. They want ranches, they don't want 2 stories, etc. Whatever the case may be here. All right, so that is functional obsolescence. Now, curable and incurable is determined by the amount of money that it's going to cost to bring it up to market standards. And so if it's a bad floor plan, there's really nothing you can do. There's no amount of money you could throw at it that would probably make it curable. I guess the best example that I was taught by my instructor was the difference between curable and incurable. Maybe you have a fuse box in your home. The standard now is breakers. The electrician comes in and says that to replace it is going to be $2,500. Well, yes, the breaker is considered, the fuse box is considered functional obsolescence because that's an out-of-date electrical system, but the $2,500 that you need to cure it it's curable. It's a curable functional obsolescence because it's only $2,500 to make the change. If you had a bad floor plan where you're going to have to do major remodeling, well, the amount that it's going to cost may actually be more than what the property value or what the property is worth. I'll give you an example. There is an area of Omaha where I live. It's West Side School District. And it's very common for people to come in and spend $300,000-$400,000 to buy a property or a house on a property only to totally demolish the property and rebuild because the area is highly sought after. There's no more room to build. So people it costs too much to remodel the property to bring it up to market standards. It's easier just to tear it down. That is functional obsolescence. And remember, it can be curable or incurable. 264 is economic depreciation, or sometimes called economic obsolescence. This is a loss in value of the real property due to external factors which the owner has no control of. So maybe crime rates have risen. Maybe there is a landfill that was built next door. Maybe a high school was built next door. Grade schools are a good thing. High schools are not. Or maybe maybe there was a major manufacturing plant that closed down and they were the major employer in town and unemployment is high. That is an impact on the value of your property. Number 265 is physical depreciation. I explained that a little bit, or sometimes called physical obsolescence. This is loss in the property value basically due to lack of maintenance. I described that in a previous slide here. So bad roof, you haven't done any painting, etc. And there is an actual loss of value due to physical depreciation. All right, the next term I'm going to talk about is what's called the gross rent multiplier, or sometimes referred to as the GRM. Now, this is used to estimate the value for 1 to 4 family residential rental properties, okay? There is a formula for this. I've done a video in great detail on this, and I'll put a link down below. But essentially, to get your GRM, we're going to take comparables of recently sold properties. So, and we're going to do this individually. So we're going to take comparison number 1. We're going to take that sale price of comparable number 1 and divide it by the monthly income of that property. And when we do that, it gives us a number, a factor. And that factor, that number is called the gross rent multiplier. All right, so that's what the gross rent multiplier, and then we apply it into a bigger formula. And again, check out that video down below. Now, 267 is the gross income multiplier, or sometimes referred to as the GIM. That is the cousin of the gross rent multiplier. Remember, the GRM is used for residential investment properties. The gross income multiplier is used for estimating value on commercial, industrial type properties. So we use the capitalization rate, which is essentially the net annual operating income. The GRM uses the monthly income. The GIM, through the cap rate or the capitalization rate, uses the net annual income, commonly referred to as the NOI, divided by the rate equals value. And again, I've done a detailed video on that as well, and I'll put a link down below. But the gross income multiplier is used for estimating value on commercial and industrial property. And then 268 is what we call the capitalization rate. The capitalization rate is used to determine the value of income producing properties. It is commonly referred to as the cap rate. And the formula is simple. It's the net annual operating income. Now, remember, net annual operating income is the gross income minus expenses, and that gives us our net operating income. In this case, we need it annualized. We take the NOI divided by the cap rate. In that video, I have a video that I did on this, and I'll put a link down below. It describes the rate. That gives us the value of the property. And again, we use this for income producing properties. We would not use the cap rate for a single family home. So that is today's vocabulary words. Thanks a lot, everybody. I'll see you in the next video.